Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now here's your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everybody's favorite topic, which is, of course, sales tax. And today we're going to go over some of the questions we've been asked during our webinars. But first, let me introduce you to my co-host, Ellie Moffat.
Hi, everyone. It's so great to be here. We love being back. We've had a couple weeks off. I'm excited for these questions that we're going to address today. But before we get to them, I'll go ahead and do a quick introduction. So for those who don't know us, we are Sales Tax and More, and this is the Sales Tax and More podcast. Please like and subscribe. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We would love to hear from you, and we would love to work with you as well. And with that, Mike, why don't we jump right in? So right off the bat here, when materials are moved to out-of-state job sites, do they trigger use tax obligations?
Great question. So let's take a step back and look at what a use tax is. And a use tax is complementary to the sales tax, and it's a tax on the storage, use, or consumption of an item. So, or nowadays a service. So when materials are moved to an out-of-state job, they're being used in another state. So storage, use, or consumption, that's the second word in the definition. So in general, there's always exceptions, but in general, yes, they can trigger use tax obligations and usually do.
Okay. So what are the hidden risks? Well, let me rephrase that. We're moving on to the next question here, but maybe I'm going too fast. So the next question here is, what are the hidden nexus risks of warranties, repairs, and subcontractor work?
Well, there are actually two major issues that I see, and you hit on one of them here. It's nexus. So whether you're using employees or whether you're using third parties, repair work, implementations, having warranties in a state. These can all be nexus creating. Now, not all states are going to look at all things the same, but if you're doing implementations, pretty much all states are going to look at that as nexus creating. If you're having contractors do it for you, even, third parties. When it comes to warranties, many states are going to look at that as nexus creating, not all states. So as with so many of our answers, it depends. In general, if you want a general answer across all the states, yes, these type of work, whether it's done by third parties or by employees, is going to be nexus creating. And many companies just don't realize that. Nowadays people say, well, we're underneath the economic nexus thresholds. Well, a physical presence is always going to, when it comes to sales tax, it's going to trump an economic nexus. And these are types of physical presence nexus. So that's number one. But I also want to talk about taxability, because now you've got nexus in another state, and many people don't realize that services can be taxable. Even when your state may actually exempt improvements to real property. Maybe you're a sign manufacturer and you're doing work installing a sign in the state of Virginia, and it's going to be a permanent improvement. Well, there's a special carve out in Virginia that says signs do not, uh, you still got to treat it as tangible personal property, even if it's an improvement to real property. So you got to collect the tax on that service. Whereas in another state, because it's an improvement to real property, maybe you don't have to collect that tax. So it's going to depend on the state, the taxability. It's going to depend on what you're doing. In New York, if you're doing, uh, let's use a sign company again. If you're installing a sign into real property for a tenant, a lot of people renting, leasing buildings, and they're installing a sign. Well, it can't be permanently attached because when the tenant changes, you're going to have to take your sign down, or you're going to have to take your sign down, and they're going to put their sign up. So by definition, that's not permanent. Whereas if the owner of the building does it and he puts a sign there, in general, that's going to be looked at as a permanent attachment and therefore an improvement to realty. So sometimes the type of project is going to impact whether it's taxable or not. And what's taxable in one state may be different in another state. And then sometimes it comes down to how you're doing your invoicing. Maybe the service by itself is not taxable, but when you bundle it together, if you do a lump sum invoice and put, a non-taxable service with a taxable item, the whole item in many, many states, the whole charge for that becomes taxable. So a lot of hidden nexus issues and a lot of hidden taxability issues. I wish I could lay out a, ground plan for you here or game plan, and tell you exactly where it's going to create nexus and exactly what's going to be taxable. But each state looks at this differently. And we could not. It would take us, days to go through all the different scenarios. And I don't think any of you want to listen to me talking for days. But we've got the answers. We can help you out, or we can find the answers. We just can't give you all the answers on a podcast like this.
No, and yeah, just to reemphasize again, Mike, that it's part of why we exist is because it's really hard to get those answers, and it's just too much for one person dealing with a few states of information. Well, past that, it starts getting too complicated. So that's why we exist, and that's why we're here. So
Yeah, and I want to jump in here. A lot of times nowadays, with all this talk of AI, people say, well, I just ask Google. Well, wrong answer, because Google can't tell what's the right answer or not. And there's so much misinformation out on the internet. The AI is just taking that information and going to regurgitate it to you. And, a lot of people take that as fact, and it's not, unfortunately so. You can't tell an auditor, well, the Google AI told me that it wasn't taxable, so it must not be taxable. That is not a defense. That auditor may actually get a good chuckle out of that. Someone the other day said, well, I just didn't know. Well, guess what? It's like TV. You watch TV and you ever hear anyone say ignorance of the law is not a defense? Well, unfortunately, that's what this is. And whether you know what it is, whether you know whether it's right or not, the state is still going to come after you. And, if you're in the wrong, they're going to assess you big money penalties. So it's up to you to figure out what is actually right or wrong, or hire someone like us. So calling a state, usually not good. You can call a state 3 or 4 times in a row and get 3 or 4 different answers. So when you're coming down to things like this, you got to dig deeper. You got to actually look at the statutes. You got to look at the rules and regulations. You can confirm something with the state, and if it matches with what you're getting from those rules or regulations or statutes, well, that gives you an extra sense of confidence. But to go to the state first and ask them, or to go to some artificial intelligence, I would not be doing that. If you do go to the state first, at least ask them to point you towards something that is going to confirm what they're saying. And if you don't want to be confrontational, say, hey, that's a great answer. Thanks for helping me out. But my boss is going to want to see something in writing. Is there any way that you can point me in the right direction or send me an email or something? And if they do, great. If they point you in the right direction, make sure you read what they're pointing you to, because very often what you're reading is going to contradict what they told you on the phone. Happens all of the time. So uh, that's why we exist. If this was easy, you wouldn't need us. I tell people all the time, we'd go do something else. There's plenty of things out there we could find to do, but because this is so complicated, um, that's why we're here. We're here to help.
Yep, and I think that little tidbit for everyone is worth your weight in gold, or if not, at least whatever your exposure is in gold. So,
I weigh a lot,
uh,
so that would mean that I got a lot of gold, huh?
yeah, I mean, it's really dependent on it's really, your weight or your exposure, whatever comes first. So, okay, Mike, let's move forward here. How can someone understand when registration is required and when it's not required?
All right, there's a lot of moving parts here. There's, what a state will say, and then there's, what we generally are going to say. What we say is if you have nexus, this link or connection with the state, and if what you sell is taxable, then you should get registered. Now, a couple of caveats. If your exposure, maybe you're only going to sell $1,000 worth of items into a state. Well, the state says, if you have nexus, you should collect the tax and remit it. But the cost of compliance is going to be a lot greater than the actual penalty and interest and tax. So, yes, the tax would be coming out of your customer's pocket if you charge them, and there wouldn't be no penalty and interest. But now you got to worry about getting registered, and you got to worry about filing returns. And whether you hire someone like us, that's a real cost, or whether you do it yourself, that takes time, and time is money. There's opportunity costs. You could be doing something else that's higher value. So we say if uh, the cost of compliance is going to be greater than your actual exposure, the penalty, the tax, and the interest, then don't do it. Now, that doesn't mean the state's not going to come after you, but it's just cheaper to reach into your pocket and pay the state that than to have to be compliant every year, um, and pay someone or yourself to do this. So um, the other thing is states don't say you need to be registered, or some states say even if what you sell is not taxable, you still need to be registered. Well, since in most states the penalties are based upon the tax you owe, if you don't have anything taxable, most of our clients would not get registered if they don't have any taxable sales. Now, you got to make sure that your sales aren't taxable, because you don't want to say, well, I don't have any taxable sales, so I'm not getting registered, and later find out that your assumption was wrong. But if you don't have any taxable sales, then a lot of our clients would just choose not to get registered. But the rule of thumb is if you have this link or connection we call Nexus, and what you sell is taxable, it's a good idea to get registered.
All right. Well, thank you so much, Mike. I think we've covered a good amount. There's a lot of really valuable tips here. So go back and re-listen, and we expand on a lot of this in other episodes of our podcast. We have webinars out there. We have lots of information and resources. And you can always contact us directly. You can reach out to me at my email is emoffat, that's EMOFFAT at salestaxandmore.com. You can also visit our website, salestaxandmore.com. And thank you so much for joining us. Please again, like and subscribe, and we hope to hear from you.
Thank you, everyone, and hope to see you on the next episode of the Sales Tax and More podcast. Bye-bye.
Thanks for listening. Be sure to hit subscribe and check out all the resources we have out on the web.